So here I'm going to talk about the balance of payments, capital flows, which is an important topic in international macroeconomics. A lot of times I actually spend a little bit more time on the equations as well as the capital flow components. And balance of payments issues are big for fixed exchange rate regimes, but a lot of times people don't talk about that term quite as much anymore. So to get started, the balance of payments records the nation's inflows and outflows of foreign exchange. So it's basically foreign assets coming into or out of a country. This is a flow variable as opposed to a stock. You could talk about FDI or other stock variables, but this works into the GDP equation, right? It's the balance, and you can have the current account on one side and then the capital financial account on the other. There's a balance sheet involved where the components balance to zero. A lot of times it's presented vertically as opposed to on the left and right hand side, but if one is positive, the other side must be negative, and I'll explain that here. And then a lot of countries have balance of payments constraints where they need the foreign exchange to fund their budget or imports and exports and stuff like that. So a lot of smaller countries have to worry about the balance of payments, especially if they're large exporters. So three components of the balance of payments are the current account, CA, which is closely tied to exports and imports. The capital account, which a lot of times I use that term KA, and you'll see that in economics, but what's really more important is the financial account. The capital account keeps the name, right? But years ago it was split into two parts. The financial account's actually much larger. And so those are kind of interchangeably used. It's either KA or FA or KFA, but it's basically what the correct name is financial account now. All right, so if one side is the current account, and if there's a trade deficit, it can be balanced through asset transfers. So if a country imports too much, they're paying for those imports by basically trading assets. Or you could also have a surplus where you can be accumulating those assets. Right? So if a country has a trade deficit, it's balanced by capital inflow, and if it has a surplus, it's balanced by capital outflow. Okay, so the U.S. for a long time has a deficit. Capital inflow means that foreign entities are owning the stock, stocks and other assets. Right? So the biggest component of the current account is the trade balance, where exports bring foreign exchange in and imports take foreign exchange out. But what makes the trade balance different from the current account is that the current account includes income receipts and payments, right? So a lot of times it's sometimes called net factor payments, but some countries actually have that as a large share of their current account, and the U.S. not so much. All right, net transfers are also included. All right, so this is for the 2018-2019 current account from the Bureau of Economic Analysis. This kind of shows the biggest components. If you notice that the tabs, anything that's tabbed in is a subgroup. So exports are a subgroup of this, and so goods are a subgroup of exports of goods and services, and the other subgroup is services, for example. And so this is the current account part where you've got exports of goods and services, and then you have these income receipts. Imports are down here. You can see here that this is a huge number. This is trillions of dollars. So exports are quite large, but you can compare the goods, for example, with the services here. So, and then this is broken down into quarterly as well. And so this is the dollar value of all these components. And you can see that goods are broken down into different types of goods, services as well, financial services, and then the income is there as well. Right. Capital account is quite small. So it's usually ignored, but the financial account is much larger. All right, and so it's sometimes KFA is the term for both, but really it's dominated by FA. All right, and like I mentioned before, sometimes people talk about capital account. Economists still do it, but the IMF renamed that in 1999. So people still use the old term. All right, financial account is capital inflows. Right, so the capital flows are measured here. It's transfer of assets. It could be securities, currency, reserves are a big part of it, so central banks accumulate those. All right, and just to recall, an inflow is an increase in foreign assets held in the country, right? So capital inflow means foreign ownership of domestic assets are growing. And outflow is an increase in domestic assets held abroad. So countries have capital outflows, that means that they're holding more assets abroad. All right, and here's the financial account again for 2018 and 2019. You can see that this is split up. Big important distinction is going to be portfolio investment and direct investment. So this is FDI and this is portfolio. And then there's another one called other, which is a lot of deposits and loans and stuff. And reserves are important, not so much for the U.S., but some countries hold a lot of foreign exchange, especially those that keep a fixed exchange rate regime. right? So those are the components, right? Like exports, imports, capital inflows and outflows, right? Now, this is the balance of payments identity, where current account plus capital financial account must equal zero. Capital account is ignored, so current account is negative FA. So if a country has a surplus of $1 million here, it has to have a deficit of the corresponding amount of a negative $1 million. Right now, I always talk about this. What if a country imports more than it exports? That means it's having extra goods coming in. Well, to pay for that, money has to be leaving the country, so they'd be basically selling off assets. They'd have a financial account surplus. So current account deficit is balanced by financial account surplus, and as a result, foreigners would own more domestic assets. Now, one that I use in class is I split off the reserve component of the financial account and have change in reserves. Basically, what that would mean is that if you had a current account deficits, you could pay for it by having negative change in reserves. And so countries that have those imports can pay for them they pay for those imports by paying down their foreign exchange reserves. You go the other way, you could have a current account surplus and you build up your reserves. And that's important for a lot of commodity exports. Okay, so having a current account surplus, you're building up your stock of foreign exchange. All right, now another equation that I like is savings investment equation. Basically, we're going to talk about a gap between savings and investment equaling the current account. So national income, GDP equation, consumption, government, investment, exports minus imports. Here's a second equation where any dollar earned has to be either consumed or saved. And notice here Y is equal. Now we're going to start by ignoring government. All right, so just leave that off. All right, and then we can set y equals to y, or c plus s equals c plus g plus I plus x minus m. Now, c's are going to cancel out. G we're basically ignoring, and then we have s and I together. So we can bring I over here, and s minus I equals x minus m. If a country has extra savings, that means they have extra goods to export. But if a country is spending more on investment, right, they're not saving enough, this will be negative. Where do they get that investment capital from? This is negative, that means that imports have to be large. So you can fuel investment through imports. So the current account is a measure of international lending and borrowing. All right, now we can bring government back in. We can say, well, let's bring government, into the equation, don't cross it out. And then now we have every dollar of income can be consumed, saved, or paid in taxes. So now we have three parts. Consumption, savings, and taxes, consumption, government, investment, x minus m. Cross out the consumption because they cancel out. Bring I over here. S minus I plus T minus G is x minus m. This is the same as before, except now you have another way to have extra money. If you tax more than your government spends, what do you do with the extra money? You can ship that abroad through the current account. But if you have a government budget deficit, government spending is too high, where do you get that money from? You can import it. So a lot of times people would talk about U.S. government spending being paid for by China. This equation would show that high government spending is balanced out by high imports. Right, so budget deficits can be another source of international borrowing. Now, as I mentioned before, capital flow is broken down into three parts. There's foreign direct investment, or FDI, portfolio, and other. All right, the big two are FDI and portfolio. FDI is larger scale. It has a 10% threshold, so you're owning a larger share of a firm, or it could be building a new plant right from scratch, so you're actually acquiring a company. Now, economic research is split, but a lot of people consider it to be more stable. All right, if there's bad news politically, you're not going to stop building the factory today, but people could sell all their stocks, right? So portfolio is going to be a little bit more unstable. Now, why is FDI good? Right? People like FDI because you can bring in technology, right? As you're building the factory, you're teaching people how to do that process. You're bringing in managerial staff. And generally speaking, that there's a whole host of processes that you're bringing in, and hopefully the locals are learning from you, all right? Another thing is economies of scale, right? So if you're building big plants, you might actually be lowering costs. Now, the other kind I mentioned was portfolio investment. It's shorter term, it's less stable, it's a smaller share of the firm. It's considered to be volatile. People can buy and sell their stocks more easily. And so if the interest rate drops or if there's a big increase in risk, right, people could basically much more easily sell their stock than they could stop building a factory. So they call it hot money. And so those inflows and outflows are a problem because they can destabilize a currency. They can have an effect on the overall macroeconomy. Okay, we can work that into those models. All right, and so people can study whether the volatility is higher. Okay, Now, portfolio is also good because it can deepen the capital markets, or you're going to have more stock shares being bought and sold. And another thing about international borrowing in general is it allows people to do what's called consumption smoothing, right? If assets are available abroad, if times are good, you can save abroad, right, through the current account. And if things are bad, you could borrow. And so one country could actually save and borrow versus other countries in case something bad happens in just one country. So an economic shock means that there's a place to borrow from. Okay. Now, if these are destabilizing, right, can these flows of capital be stopped? And so those are called capital controls. All right. So capital outflows we can see in an exchange rate model. Those cause depreciation, and inflows can lead to an appreciation. All right. And so that's going to have an effect on GDP that we'll see elsewhere. Right. So depreciation can hurt exports. It can hurt the trade balance. So people might not like the destabilizing effect of currency, or capital movements on the exchange rate and on the economy, so they can institute those controls. And so the Asian crisis of 1997 was a big outflow, and Malaysia instituted capital controls. And then when times were good in Brazil in 2009, it was actually pushing their currency up. And so they put some capital controls there. So some people advocate for restricting these flows to help stabilize the country. Now, what could you do to have those? Basically, like anything in economics, you could have limits on the price and quantity. You could tax capital movements, or you could restrict the quantity. But people can get around them through various accounting techniques. Okay, so some types. You could restrict domestic investors. They can't own foreign assets, so you can keep your people from buying abroad. You could tax repatriation of profits, so people put money abroad, you can tax the money coming back in. Or you could say that you can buy stock, but you can't sell it right away. That can keep it from being so volatile. You have to hold it a certain time. All right. Or you can keep money from coming in. You can keep foreign investors from owning your assets. Okay, so you can have a rule limiting the percentage of your company held by foreigners. You could say that all investment must have some sort of a reserve requirement. Right, so those are some ideas of capital controls. But what we saw is that we measured the balance of payments, and we were able to talk about some equations, and then we were able to talk about those capital controls.